Okay, good morning for this last session. The courageous ones who are still here. I will just mention a cartoon because it's the last session, so we can afford that. And I love cartoons. And that one, which you may have seen, it's a very famous one. It shows Bill Clinton on one side in campaigning in 1992. And the bubble says, it's the economy, stupid. And there is Greta Thunberg climbing a ladder, arriving at the top, crossing economy, and writing planet. It's the planet, stupid. Now, I think it's both. It's the economy and the planet, stupid. And to convince us of this, we've got 4 really experienced speakers who will tell us about the economics of this transition and decarbonization. They will first talk about some dark sides of this decarbonization, and then we will have some words about the risk associated with different types of companies and types of projects. And I will first call Professor Kramp, who is an emeritus professor at the famous Toulouse School of Economics. He also served on the Economic Council of the French energy regulator and on the Conseil National de la Recherche Scientifique, the Scientific Research Council. And his research now focuses on industrial organization and regulation economics. So, Mr. Kramp, the floor is yours.
Thank you, Anne. I hope that I don't be too much stupid. And let me first convey to 2 guys that maybe you were not ready to see together. But they are like us. They consider that electrification is very important. So Lenin saw that ex ante. Armstrong was speaking ex post, but they agree, at least on that. Actually, the opinion of Neil Armstrong is not his personal opinion. At that time, he was the chairman of a committee within the US Engineering Association, I don't remember the name, and they were in charge of writing a report on what they consider as being the main achievement of the 20th century. And they wrote this ranking. So I will not discuss the detail of the ranking. And we could discuss for a long time why computers are number 8 and so on, but I think that we can agree on the fact that electrification is really the leading innovation. It's kind of a mega innovation. And the main reason that Armstrong and his pal were proposing that actually without electrification, almost all the other ones were impossible. So it was really the main step that allowed almost all the other ones. And they had other reasons, so I will not discuss about all of them, but there are also reasons in terms of fairness, the fact that rural population and urban population were treated the same and so on. So it was a very interesting report, so if you have the opportunity to read it. So we agree electrification is a great thing, but there is always a but. There is always a dark side in all what we do. So in economics, on one side we're this, but on the other side we're that. So, but up to now, electrification mainly has meant, and for long it will be the same, wiring. That means installing millions and millions of kilometers of lines, millions of poles, thousands and thousands of transformers, not to mention the metals. So actually, when you look at what I name the dark side of electrification, the cost is really huge. If you just look at France, so RT in France is for high voltage transmission, Enedis is the main operator for distribution. You see that every year, jointly, they invest close to 5 billion euros every year. And the French consumers every year pay them some 18 billion euros. When I look at my electricity bill, there are more or less 3/3. Okay? 1/3 for energy, 1/3 for transmission and distribution. And the last third, of course, because we are in France, the last third is for taxes. But transport and distribution, transmission and distribution is 1/3 of that. This is the cost that we pay. And of course, this is just the economic cost. Now, when you consider also the environmental cost, the effect on landscape, the effect on biodiversity, the Wi-Fi. So you know that in California, PG is not a very good position. I read somewhere that Erin Brockovich was back. And they will face a class action. This is not Julia Roberts. They will do another movie on that. And last week, SC, the Southern California Edison and PG, preferred to disconnect 2 million people rather than to face the risk of some burning forest. So the question that I would like to ask is, why do we accept to pay such a high cost? Do we really need this grid or all this investment? And I think yes. And the reason is that up to now, we are totally unable to store electric energy. 1.5 centuries after the beginning of the electric era, we don't know how to store electric energy. And this has many consequences. Of course, in general, when we speak about non-storability, we rather have in mind the time dimension of the problem, the time consequence. That is, we are permanently obliged to balance supply and demand. That's what we have in mind. But there is another consequence. If we cannot store energy, we cannot put it into boxes. That exactly what we cannot do is this. We cannot go to the supermarket and come back with washing powder and cans of beans and liters of bottles of wine or beers and boxes full of electricity. We don't know how to do that. See, if we don't know how to do that, we are obliged to be directly connected to production nodes. If you, like a troll, you enter any electrical appliances here, you can end out facing a hydropower plant or a nuclear reactor, because it is a direct connection we have to the production nodes. Of course, you could object, but what about hydroelectric storage? Pump hydro storage, what we name in French STEP, station de transfert d'énergie par pompage. What about the batteries that are increasingly larger and larger? You have seen probably that the Nobel Prize in chemistry has been awarded to 3 researchers that have developed in the lithium-ion batteries. Well, the answer is that this is indirect storage. And indirect storage has many problems, but one actually is that as you transform electric energy into another form of energy and then back into electric energy, this double transformation incurs plenty of energy losses. For a pump hydro station, it's around 20% that are lost. And if there is this loss, it means that along the year, if you look at the net contribution of any storage installation, it is negative. It is negative because you need more energy than what you can release. Okay? So, because of all of that, and up to now, the electricity storage remains, and indirect actually, remains a very small part of the total production. You see on this diagram, you see the total production of the USA, 4 million of terawatt hours a year. And if you want to see where storage is, you are obliged to go into the details of a small square and to magnify it. You see 23 gigawatt hours. Or you could say, yeah, but we can use it several times a year, of course. But if you use, let's say, 300 times this 23 gigawatt hours, you obtain some 6,000 gigawatt hours. That is the size of one of the small square. Okay? So it is very small. So it means that for long, the power grid will remain the least bad option to provide electricity consumption nodes, clean energy. But just a word to finish for the 1 billion people who have no connection to the grid. So for them, probably a combination of distributed production and batteries will be a good alternative. But now we're facing a new problem that has been quoted several times, the recycling of batteries. What to do with this? Thank you.
Very much. Merci. And now I will call Mr. Magwood for another dark side with system costs. Mr. Magwood has been since 2014 the Director General of the OECD Nuclear Energy Agency. Actually, he knows everything about nuclear because he's got a long career in the nuclear field, including with the Department of Energy, and he's also been appointed as a commissioner on the US Nuclear Regulatory Commission. So, Mr. Magwood, the floor is yours.
Bonjour à tous. It's a pleasure to be here this morning. I'm sorry I wasn't here earlier in the conference. I've captured this bug that's going around Paris. It's knocked a lot of people out. But you've all been in Paris for the last few days, so you're all going to take this back home with you when you go. So I hope you enjoy it as much as I did. I'm going to talk for a few minutes today about the general issues of the cost of the overall system when it comes to decarbonization. But I want to put it in a perspective where we have often been asked about where does nuclear sit in all this. And it's very clear that when you see nuclear today, you look at nuclear both in terms of the possibility for new plants and for existing plants. For existing plants, it's a very, very tough situation. For many existing plants, the market has changed around them, and they are not making the money that they used to make, which makes the future very uncertain in many markets. And when we see this, we see often that this reflects something that is not talked about very often, which is the fact that the markets actually don't work the way they're supposed to. This is something that we have looked at, and I know the Fatih Bureau, my colleague from the IEA was here, his organization looked at. The markets actually are not working very well at all. And in many parts of the OECD framework, the markets are actually broken. I'm willing to use that word because they aren't accomplishing the goals that they're set out to do. So nuclear is caught in the middle of that with other sources as well. New plants is another interesting conversation, and I know many of you have observed how in nuclear space we've seen these major cost overruns and project problems, and that's something that I'll talk about in a second. But I wanted to, oops, wrong way. There we are. I wanted to, I'm going to skip the introduction just to say that the NEA is an organization of 33 governments that work together on these issues. And one thing that I've seen as I've talked to ministers in different countries about these issues is the level of uncertainty about the future is probably higher today than it's ever been since I've been in this business, and it's really quite remarkable. And I was very interested to hear Bernard's panel a few minutes ago talk about how industry is responding to this, and I kind of feel sorry for people in industry because if you go into the ministries and you talk to people, they say, well, you know, we have this policy, but we're not really sure where this is going. And but industries pose a plan for that. So we look at this as best we can based on the information we have, and we have a series of reports, and our website has all our reports available for download. And the most recent was the cost of decarbonization. And in that, we analyze the fact that there is this issue of system costs, which doesn't get picked up very clearly. Very often when we see one energy source compared to another, nuclear versus wind or solar or something else, there's a tendency to compare the cost of the power coming off of a nuclear plant versus the cost of the power coming off of a wind farm versus the cost of power somewhere else. And that really doesn't tell the story. What you really need to look at is the overall impact of all the energy resources on the grid itself, the system costs. In the case of variable renewable energy, what we have found in our analysis is that there are some pretty significant costs. This chart shows that these costs are composed of profile costs, which just simply reflect the fact that, for example, in the case of solar, that at 12 o'clock noon, you have plenty of solar and you're doing very well. At midnight, you have very little solar. And when you have that kind of profile, you have to have backup power supplies that are going to come online, and somebody has to pay for that, and that has a cost. Also, there's a balancing cost, and that just simply reflects the fact that the wind isn't blowing consistently when you think it's going to blow. We have these wonderful models, which are very good, but once in a while the models are a little bit wrong, so we get less energy than we were supposed to get, so you have to put more energy in the grid from someplace. There's a cost of that. And the previous speaker talked quite detailed about the transmission and distribution costs. They're actually quite significant. So when we look at all these costs together, plus the cost of generating electricity, we find some interesting things. This chart reflects where we are about today. So you have about a 10% variable renewable case. It's kind of about the magnitude you see in a lot of markets. This kind of curve is very well understood by people in the electricity business. The residual demand is, it has some variances, but it's something that I think we're used to. You go to very high levels of renewables, and you see this exaggerated case, 75% variable renewables, and you see the residual demand is extremely unpredictable, has a lot of inefficiencies built into it. In fact, as this chart indicates, you have an overall excess production of about 37%. Which would be great if you had a good place to store it, but if you don't, that becomes a bit of an issue. So this is something that, quite frankly, we don't know how to do this. So that when you see these large numbers for renewables, keep in mind, we don't know how to manage a grid that behaves that way. The costs are also quite significant. At the base case, about 10%, you see the bar on the far left-hand side of the chart. But if you have a very large loading of variable renewables, the overall system cost is actually quite large, and the overall cost of electricity actually doubles if you look at the last bar. These are real costs. These are costs that have to be absorbed by the market and have to be paid for, but often they don't come into the calculations that we see when people are comparing one energy source to another. So our report makes a variety of recommendations. I won't spend a lot of time with all of them. I think there are things that are quite familiar to all of you. But basically, the story is that we really ought to be looking at these costs very carefully. And when we're making decisions about our resources for the future, we ought to be looking economy by economy, market by market, at what the overall costs are and to make the right decision based on the cost that we have. And in some cases, that does open the door for new nuclear, we believe. That said, because we're seeing these very, very high capital expenditures for nuclear, even if the markets are adjusted, are going to have a very difficult time being competitive. So that's why we see such a large interest in these new technologies, small reactors, advanced reactors. And over the next 5 to 10 years, we're going to see a lot of these technologies come on the market and quite possibly really change the game in the whole conversation about energy going forward. So thank you very much.
Thank you very much. You're a very precise person. Just taking exactly 7 minutes. And I will now call our next speaker, who is Douglas Segers, who's been with Moody's for the last 5 years as the managing director responsible for their EMA project and infrastructure finance ratings group. And before that, his 30 years career in Europe and Americas was focused on infrastructure and public finance, and including with the UK Treasury.
Yes, thank you very much, Anne. Pleasure to be here this afternoon. Thank you for persevering through the last session. You've had a day and a half of some very interesting sessions, and I've attended some of them very technical in many respects, and quite fascinating for people like me who are used to dealing in the pounds and pence and euros and cents world. But one thing that comes out of all of this discussion of the way forward and the avenues that we might all perceive is that as much as Ms. Thunberg would like to avoid this, it does cost money. And that has to come from somewhere. And as soon as you bring that into the equation, you have to think about the risk. The vast majority of money that goes into the world of electrical power generation, transmission and distribution comes traditionally out of pools of capital that are very risk averse, that are looking for very long-term, stable returns. And as the industry that we've been talking about for the last couple of days moves into a much heavier vein of innovation, technological change, that historical pool of capital starts to get nervous. So I want to spend few minutes talking about that, and then join the discussion. So the theme of this panel is the economics of electrification. Now, Moody's, as a credit rating agency, thinks about economics in a very specific sense. What is the risk that a borrower in one of these areas, generation, transmission, supply, encounters an increase in cost or reduction in revenues that is sufficiently large to change the likelihood that it will be able to repay its debt on time and in full? For decades, utilities have been seen as an archetypal, stable investment. You cannot lose money. Returns have been commensurately low. That was the bargain that investors made. But the electricity market is undergoing a tremendous shift driven by societal preferences that are then reflected in government policies to drive decarbonization of the sector. So I want to talk about what that means from a risk point of view. The impact of environmental policy depends greatly on where you play in this value chain. It's different for generators, it's different for the grids. And if you want to look at it on a spectrum, the area that is going to be most affected by this would be generation that is based in old carbon-intensive technologies. The coal-fired plants, followed by the gas-fired plants, and then moving through to the renewables that actually be the beneficiaries of these policies. There are also, as other people have noted, quite distinct differences depending upon where you are, what technologies you're using, what subsidies and incentives you face. So it's not a global picture anymore. They don't all work the same way. Now, this industry is basically divided into 2.5 ways of approaching the world. The first is regulated utilities, and by utilities I mean anyone who generates, transmits, or distributes power. The regulated utilities, the clue's in the name, they have a statutory right to charge a certain amount. Unregulated utilities, same business, but they're exposed to market risks. The half is the interesting part of the financial engineering, which is standalone generation projects that are financed on a non-recourse basis, project financing. And the power generation world has been filled with those for years. So regulated utilities, first, are generally experienced in handling progressively more stringent environmental regulation. Historically, this has been in the realm of air pollution, particulates, emissions, that sort of thing. They've historically been able to recover those costs through relatively well-defined regulatory systems. They know how they work, they know what they can get paid for, and therefore what they have to do. But there's always a political trade-off. It is always a question about increasing consumer bills to mitigate environmental risks and the political difficulties that arise. Particularly, you get into the world of energy poverty. And as the cost of innovation and risk rises, you will be in a position where you might see generators being less able to recover those costs, and their credit metrics will suffer, which means their cost of capital will rise. In addition, you have the secondary effects. You could have increases in distributed generation, by which I mean very localized generation, or lower sales volumes because people turn to energy efficiency and they use less electricity. While that's all very good for the environment, it doesn't do anything for the revenues of the utility that's making the investments on which everyone depends. So all that could lead to a shift in market fundamentals or the regulatory paradigm, which creates additional risk for these regulated utilities, especially those that are dependent upon volume charges to cover their fixed expenses. So what might happen? Regulators may need to look at adjustments to the pricing mechanisms so that you look at your power bill and a third of it is the power you use. You might see another chunk of it coming in to deal with some of these uncertainties. Or in an extreme situation, you might find that distributed generation becomes so prevalent that utilities are no longer natural monopolies. And therefore, you might have the dramatic step of complete deregulation. You have a similar effect with networks. People don't think about networks very often, but the map with the wires kind of tells you that that's a critical part of it. What's happening now is that those networks are undergoing an enormous capital expenditure program to deal with dispersed generation. And as that dispersion continues, it becomes more and more difficult to balance the grid, to manage the flows. So again, regulation is going to need to adapt to allow those networks to attract the capital they need to keep making those investments. And why is that? Because networks often have a very large component of their compensation to which they're regulatorily entitled based upon maintaining availability of the system. And if you have continual outages caused by technical problems in trying to balance a highly dispersed generation grid, then the regulation fails and the market doesn't work the way it's supposed to work. So let's move to the unregulated sector. In contrast to the regulated peers, unregulated utilities are directly exposed to market risk. Interesting, in Europe, these are the largest companies that Moody's rates, including our hosts here, EDF. What's happened in the unregulated markets is that government incentives, societal preferences have driven to a world of increased renewable capacity, closing down thermal capacity, decommissioning nuclear capacity. And so renewables have increased market share. You also have the use of priority dispatch rules and the lower absolute cost of power that renewables have started to generate recently, which it means that we have seen the overall credit quality of those unregulated utilities drop. So over the last 10 years, to try to crystallize that for you, 10 years ago, the average rating of the unregulated utilities in Europe, we rate about 40 of them, was somewhere between A2 and A3, which in our world is quite strong investment grade. Today, it's Baa2, which is skimming along the bottom of investment grade towards non-investment grade. And that is almost entirely down to increased CapEx financed by debt, the costs associated with decommissioning thermal and nuclear assets, and falling power prices. It's probably worth noting as well that the absolute cost of this has been mitigated by the long, relatively benign interest rate environment that we're in, so it could have been a lot worse. So that was a bit gloomy, but what I can say is that the tide does appear to be turning. The trend of investment in renewables has started to pay off. Power prices have stabilized since the trough at the beginning of 2016. And as a result, financial metrics have improved. That said, there are still pockets of fairly high risk coming from companies that, either from a business strategy point of view or because they're based in jurisdictions that have not embraced decarbonization, are still very heavily invested in thermal production and have not made significant moves towards decarbonization. Now, a quick word on power projects. Power projects are a bit the orphan child, but they become interesting when you think about how all of the innovation is going to be financed, because you can easily imagine a world where you try to isolate, if you're a corporation, try to isolate your higher risk programs from your main corporate balance sheet. What has to happen with that is that you have to create a structure that ring fences a lot of risks. Now, over the last decade or so, the vast majority of power projects in Europe have been renewables. That's not a surprise. What's been interesting about them is that they have always been structured to be at the bottom of the investment grade level. That is a sweet spot for the investment. Nothing wrong with that. What's interesting is that has not changed the credit profile over the last 10 to 15 years, because what has happened is the original power projects for renewables got a lot of their credit strength from subsidies. A few years ago, Spain and Italy did some retrospective adjustments to the tariff world, which pretty much shocked the market. And sponsors started thinking, well, this regulatory risk is a bigger thing than I thought. would I not be better off going for unsubsidized? And that is what has happened. So over the last 2 years, we've seen a huge influx of projects that have come on an unsubsidized basis. So essentially, investors have traded regulatory risk for market risk, and it's been a good bet so far because the absolute cost of power production for renewables has fallen, and the investment has fallen quite rapidly, making it very attractive on a market basis. So with that, I'll stop. Leave the thoughts about risk in your mind, and we can turn to how we actually raise the money, I think.
And I will now call our last and fourth speaker, Mr. Daniel Ford, who's been for the last 2 years at UBS as a managing director and head of the North America Utilities Equity Research. And prior to that, he's held many positions related all to energy, utilities, and environmental services stocks in an impressive number of different financial institutions, from Barclays to Lehman Brothers to whatever, Merrill Lynch, Morgan Stanley, etc. So the floor is yours.
As my wife says, I struggle to keep a job. So I'm last, but I'm optimistic, and so I hope to end this on a very good note. We right now, in North America anyway, see an unusual, almost unholy alliance between the interests of customers, policymakers, and regulators, and shareholders in electric utilities. One of the things that we're very optimistic about is the topic of this conference, efficient electrification. And I want to thank EDF as well as the Electric Power Research Institute for hosting the conference. I think it's very valuable. So let me take you through the 3 reasons that we're optimistic and what we think the punchline is. We think that efficient electrification in the U.S. is likely to expand the end-use BTU content of demand in North America from about 20% electric today to about 40% electric in 2050. That has the promise to increase our sales growth from where we've been hovering net of energy efficiency at around 0 to something between 1% and 2% a year as this transition takes place. The building blocks for it are advantaged by the low carbon social policies that exist, but the root cause of them is actually what we think is just better economics. Electricity, first and foremost, is a bargain. Electricity today is on an overall consumer income basis at the same price in the U.S. that it was in 1972. There's been inflation in almost everything else that you can find. We had very little to do with that benefit, but it sets us up very well for electrification going forward. What's driven that to date is, first, in the U.S., and I know it's different here, taxes have been going down since Ronald Reagan was president. Second, the cost of capital has been in decline since 1982, when the 10-year Treasury note was at 16. It's now at 1.7. And then third, shale fractionation collapsed the fossil BTU price complex from about $10 in 2008 to between $1 and $3 today. Going forward, we think that this gets extended by 2 really key new drivers. The addition of renewables that are now economic. They once were not. But the marginal cost of new entrant wind and solar is below the marginal cost of old coal in particular. And in nuclear, in many cases, I hope that doesn't result in the demise of nuclear, because I think it has a very important role. But coal can go away, and it's going to. And it will go away with lower costs than where we are. It's a help that in the U.S. they're almost fully depreciated, so they're 40 years. And so when they go away, it's going to be sort of a natural death, which is nice. The other real advantage is automation, digitization, whatever you want to call it, coupled with a huge advantage of the fact that utilities are what they are, which is a stodgy old industry, historically, that is unionized. And the output of that is that the average utility worker in the United States is 55 years old. As those utility workers retire, if I was going to replace them one for one, I'd be able to do it at 50 to 60 cents on the dollar. With digitization and automation, I'm not going to replace them one for one. I'm also not going to cause a lot of stress with early retirements. They're just going to retire. And that's a huge bend in the cost curve. Why does this matter to me as an equity holder? I get paid for capital intensity. Every dollar of operating costs that I save, be it taxes, interest rates, operating and maintenance expenses, or fuel, funds $8 of capital expenditures without an impact on the customer. And so it's very, very leveraging. Second thing, electric applications. A lot of the people here are very involved in the engineering. Electric applications are finally at the point where they're cost competitive. We think in the next 3 years, or UBS thinks, that we're going to have a life cycle crossover of light-duty electric vehicles with internal combustion engines, and that will be the tipping point where we'll actually have people choosing electric vehicles regardless of their social outcomes. And we think that will ramp up to where we will see an acceleration to 1 in 3 cars being electric in the U.S. sold in 2030 from very little today. See a lot of promise in heat pumps, replacing traditional fossil home heating, and we see a number of industrial applications which have been explored at this conference. And then finally, we're definitely seeing some societal preference changes that also have some interesting impacts. Decarbonization clearly is an important driver into the future. And where it hits my customer, so where it really hits cost of capital, is not with the science of decarbonization, not with the social outcome of decarbonization, but the fact that my key clients' kids care about it. And what that's done is that's created environmental, social, and governance-style investing, along with some other socially responsible outlets, that is the biggest source of growth in actively managed equity dollars in the globe. Number 2 is infrastructure investing, which is somewhat tied to it. Actively managed is code in my business for high margin. And so that attraction makes it extraordinarily important and drives down the cost of capital. We heard a little bit about green bonds and some substitution for green bonds. This is the equity version of that. We think that that's pretty important. Now, rather than be entirely Pollyanna, because the truth is my job is to be an umpire. I'm as quick to be negative as positive, and as I already explained, I'm positive for the reasons I stated. But the things that worry me, and that could change my opinion very, very rapidly, is first, what this has done to the preference order in customers' minds, because at the end of the day, any business is about the customer. The preference order in customers' minds has moved from price being number 1 a decade ago to now price being number 3. Number 1 is reliability, because with digitization means that we're all connected and we're frustrated by outages. And number 2 is environment. The one that worries me is the reliability component. As we add more renewables, more interruptible resources, that's harder to manage. We also have cyber and physical threats that are connected and disconnected, with the environmental outcome that we discussed. A big blackout will have important people looking for the cause. And if we're the cause, which we will be, or will be blamed for it, that could be quite disruptive. And so that's the thing that worries me the most. And with that, I'll stop. Thank you.
Thank you very much. Thank you very much. We've got very little time for questions, but I'm going to ask a very quick question, and maybe I'll start with you, since you so that we can go on. You didn't mention anything about what a company like yours does in relation to stranded costs, the retirement of carbon assets.
So stranded costs are a good question. North America is a little bit different than the condition in Europe, and it does break down between regulated utilities and unregulated utilities. So unregulated utilities, stranded costs is borne by the shareholder and the debtor, and that's the deal that they've struck, and risk is priced for it. In the regulated world, one of the benefits of being from the U.S. is we've had publicly traded electric utilities much longer than any place else on the planet. Started around 1900. And as a result, the case law has been settled. Stranded costs, the war's been had, utilities won, they get their money back. The only question is how. And the tool that's used in the U.S. commonly is securitization. So what we do, if a plant has been placed in service under a regulatory order and it's used and useful and it's no longer valuable, then the states and the regulator can refinance it with a low-cost bond issuance and pay off the equity holders and the existing bond issuers. So it's something that doesn't rise in my risk spectrum as much as reliability.
Thank you. Now go on with Mr. Seghers. Maybe who can tell us what he thinks we can do to mitigate this risk he's been mentioning. Should we revise tariffs? What is the priority?
Well, I think part of it is making a societal decision about where you want to go, which is not as fuzzy as an answer as it seems. Because as Dan said, different places have cracked this question differently. And I think that when you start looking at balancing this question of reliability, which implies that you're not in a world of move fast, break things, that doesn't really work for power systems, people need to be prepared to pay for that. And that may mean being prepared to pay for things that might have a relatively short life because they become obsolete economically. And it gets you into this world of stranded assets. We historically think of stranded assets as a nuclear plant that is no longer economically viable because better technology has come, or a coal-fired plant that is no longer economically viable because of the shale revolution. But you could also have the concept, in the discussion this morning on electric vehicles, thinking electrical charging points could become obsolete because somebody figures out a way that is dramatically better to do it than we did it 8 years ago. Yet someone has spent an enormous amount of money to install thousands and thousands of charging points that now nobody wants to use. And you can go back to the old world of, who buys CDs and videotapes anymore? But the kind of capital commitment that power systems require are no longer about consumer choices, and we just kind of throw out our videotapes and stream things instead. You need to have a change in the regulatory view, which is still somewhat stuck in an old world of the equity takes the risk, the creditors take the risk, because that is going to be too expensive to do these large-scale society-wide changes.
Thank you. And Mr. Magwood, with your huge experience in the nuclear field, how do you explain that we now see at the moment where we need nuclear to decarbonize the electricity sector, that we see that in the last 2 years there's been a stalling of the nuclear electricity production? How do you explain? What is the main reason? What should we do?
Well, as I mentioned, a big factor is the fact that the markets have changed around the plant. The plants actually are operating as well or better economically than they really ever have. But surrounding them is a situation where, because of policy changes, mostly introduction of renewables, which have suppressed market prices in some places, along with, in North America, the shale revolution, which is almost impossible to overstate how big of an impact that's had on the energy systems in the U.S. It's squeezed nuclear in a way that is very difficult to adjust to, because it costs a certain amount of money to run a nuclear power plant. And the industry's actually done a very good job bringing the cost down, but there's a limit to how much you can do that. So looking in the longer term future, I think there's a lot of people that have come to the conclusion that you need to have a much lower cost profile type of nuclear system to be competitive in the future market, and that the current plants are going to be increasingly under stress as these market evolutions continue. But at the same time, I think it's worth pointing out that policymakers haven't really fully understood the impact of all the decisions they've made, and particularly for those who are advocating for low CO2, they ought to reward capacity that does what they're trying to achieve, and they have not done that.
Thank you. And then maybe last question, because I was intrigued by your last slides on the wire grid and its importance as least bad solution. How do you see it? Do you see it as remaining central because the system will remain very centralized? Or do you see it with another objective in a mostly decentralized system? And then with what kind of business model?
Yeah, things are changing everywhere. It's the same for the transmission system. For long, it was just a system to transmit. And now it's changing to some form of a marketplace. And like in all marketplaces, you need to have a central controller who is cleaning the place, making it safe for tradable activities. So in the electricity case, it's even more important than in others because any connected agent produces externalities, because electricity is circulating at the speed of light, because there are loop flows, because it is not storable, and so on. So you need to have some kind of last resort decision maker. But it doesn't mean that he must be a dictator. It can be managed in a very soft way. Last week, for instance, I think it was on Monday in France, we had a problem of frequency decrease. And RTE, who is the operator of the system, fixed that by disconnecting, interrupting the provision, the supply of energy to big consumers. But it is contractual. It is a contract that these big consumers have signed, so, and they are rewarded for that. So it is not just a dictator decision. And so after this institution or this centralized body, it can be the association of several ones, like in Western Europe, it is tightly coordinated. Once this marketplace is safe, well, you can accept any kind of transaction there with new contracts, like contract contingent on the state of nature, contingent on the time of use, contingent on the wholesale prices, contract bundling, energy service, energy provision, or insurance contracts for you have the prosumers who prefer to consume their own energy, but they prefer to be sure they will have energy independently of the weather conditions above the top four. So you need both. A dose of centralization with plenty of decentralized decisions.
Okay, well, thank you very much to all our speakers who will, I think, remain here for before we conclude this conference this morning. And I will call on the stage Mike Howard and Bernard Salah, who've got things to tell you for next year, I understand.
So we are coming at the end of this conference, and I would like really to thank our speakers, the last one, but also the previous one, for their outstanding performance and very, very interesting discussion. I would like also to thank Mike. Mike, it was great. Thanks to EPRI.
Thank you.
And perhaps also two key person who really manage the event from the early beginning, at the beginning of this year to today. So Clémence, could you stand up, Clémence? Clémence Alasseur from EDF. And Marc Duval, where is Marc? Yeah, there behind. Thank you, Marc. Well, and this was Electrification Europe, but there is a next one, Mike.
Yeah, thank you, Bernard, and really, again, I appreciate everyone being here. Appreciate our speakers, and you know, behind the folks that Bernard introduced is a whole team of people that spend many hours pulling all of this together, and just really appreciate what they've done. I also appreciate the sponsors here, Bernard. Just a great turnout. Appreciate every one of you who attended. And, you know, this is really only the start of the discussion. Electrification is something that we at EPRI and at EDF, we've been involved in this for many decades. But now, as I said yesterday morning, the focus on using cleaner generation to electrify everything that we're doing is so critically important. We have a huge responsibility to advance the technology, advance the solutions, advance the discussion, not only just here in France or the US, but really around the world. And so while we come to the end of this event, it's really just the start of the discussion. And so the next Electrification Conference is going to be in Charlotte, North Carolina. And Swati is here as the Senior Vice President for Duke Energy, which will be the host city of the next meeting. And I'm going to let Swati kind of introduce it, and then I'll wrap it up.
Okay. Thank you. Is this on? Yeah. I do want to thank Mike and Bernard, for hosting this. This has been such a great event, from a learning perspective, but also from networking perspective of trying to bring all the ideas together as an industry to uplift us. So thank you for hosting it. And it's our pleasure to host it in Charlotte, North Carolina. Let me tell you a little bit about Charlotte. Charlotte is 16th largest city in the US. It is 5th largest, fastest growing city in US. It has a lot of diversity, 25 universities and colleges around in the metropolitan area. So huge amount of human capital, lots of innovation going on in our fair city. So you will enjoy seeing our city. For the ones who are a little bit more brave, a little bit more adventurous, I also wanted to say it's a city which hubs the NASCAR. So if you like fast cars, please have some time before or after the conference and enjoy that. You can drive that fast car in Lowe's Motor Speedway. For the others who want to relax a little bit, it's also Mecca for craft beer. So we have 250 breweries. So it's not just the conference, but it's also the ecosystem around that will hopefully really invite you to come to Charlotte, North Carolina. A little bit about Duke Energy. Duke Energy is headquartered in Charlotte, North Carolina. It's one of the largest investor-owned utility in the United States. We are in 6 states. We own 55,000 almost generation. We own and operate. I'd like to say 20% of our generation is nuclear, and we have just started renewing our license. They are all INPO 1, so we are really hopeful we can renew that. We've also added 7,100 renewable generation to our mix where we own and operate. So that's just to say that Duke Energy really believes in decarbonization. Why? Because our mission is to serve our customers with clean and affordable energy. To that extent, we have reduced our coal fleet by half. We have reduced our emission by 31%, well on our way to reduce another half by 2030. We have reduced our SO2 by 96%. We have reduced our NOx by 74%. So decarbonization is not just something we have to do. We feel like that's our responsibility to do. That's what our customer demand. So providing cleaner energy to our customer is our motto, our vision. But as we think about beyond generation, we talk about decarbonization around generation. We think grid offers a lot of opportunity. So Duke Energy has committed to spend $25 billion over the next 10 years to modernize the grid. And when we say modernize, it's just not physical infrastructure, but providing services to customer where they can be more efficient. So we have deployed AMI meters to our customer, where 62% of our customers today have almost real-time information, so that they can make smarter energy decisions. And we are not enabling them just with data, but with products and services that they can take the data and utilize and be smarter. So it is about energy efficiency, it's about demand side, it's about customers. Sometimes we think of decarbonization in generation, transmission, and distribution perspective, but we forget the customer. Customer has a big role in how they can play in decarbonizing and being more efficient with it. Of course, with all this creates a lot of opportunity to also utility to play a big role in transportation. Electrifying transportation is core to our strategy as well. We have deployed numerous stations within our territory that I hope you get to see. We have partnered with Verizon and others to bring 5G and other things, small cells, digital kiosks into our cities, making it smarter cities. We have really a big investment in front of our commission to allow us to jumpstart. This is not to say that the utilities need to do everything as it relates to an electric vehicle, but we feel like we can jumpstart the marketplace by starting the infrastructure investment, by starting and creating funds to fund the startups. So we have we call it a venture fund at Duke Energy, that we invest in our startups, that we encourage them to come up with technology. So it's not about utility doing everything. Our motto is utility becomes the integrator, the enabler. We don't have to do everything, but we create an ecosystem that I think utility can do much more efficiently than just each one doing on their own. Over and above that, we feel like innovation is a big part of it. Digitization, call it whatever. We are really innovating the way we do what we do. We talked about economics today. We are creating that headroom by really reducing our O&M. We are tracking our trucks. We are trying to make sure that there is efficiency in how we do our stuff today. We are reducing our O&M, at least keeping it flat to reducing. That creates headroom to more invest in things that will really help with decarbonization and smarter energy future. So Duke Energy is super excited to be part of this conference, part of the dialogue, because I have been enriched by lots of things that I've heard, and it's gotten my head turning to say, we haven't thought it that way. So I really invite you to Charlotte, North Carolina next year, because I think in spring of 2020, you have to be there to continue this dialogue, continue the sharing of ideas that will really enable all of us to get to the decarbonization goal and to the smarter energy future. Thank you.
Thank you very much. And so just to add a couple of additional exclamation points to what she just said. Charlotte is really a lovely city, and springtime in Charlotte is fantastic. It's beautiful. It starts April the 6th. Great airport, so you can fly straight from Europe and many other places around the world without touching down in another city before you get there. And you will hear a lot more about electrification. We've got startup companies that will be there, and we're just going to continue this discussion on electrification and just keep going. So again, thank you for that kind of tee up for Charlotte. You will get information about this event coming up in April very, very soon, and look forward to another discussion with global input on the importance of electrification to decarbonize the entire economy. So with that, Bernard, again, thank you very, very much. It's been a pleasure co-hosting this with you. Really enjoyed the dialogue that we've had this week and leading up to this event. And so thank you very, very much, and thanks to everyone here.
Thank you, Mike. Thank you. Thank you.
Excellent.
Thank you for the organization.
Excellent. And we wish you all a very safe trip back home. And
Yeah,
we'll
hope to see
see
you.
you soon in Charlotte, April the 6th. Be there.